Today, we're diving into the fascinating world of options trading, a topic that's gaining traction among novice traders. So what exactly is options trading? In simple terms, it involves contracts that give you the right, but not the obligation, to buy or sell an underlying asset at a predetermined price before a specific date. This flexibility makes options a powerful tool in the financial markets. For beginners, understanding options trading is crucial because it opens up a realm of opportunities for profit and risk management. Whether you're looking to hedge your investments or speculate on price movements, options can be a game changer. In this video, we'll break down the basic concepts and strategies that every aspiring trader should know. By the end, you'll have a solid foundation to start your options trading journey. You'll learn how to navigate the complexities of the market, identify potential trades, and make informed decisions. So, stick around and let's unlock the potential of options trading together. What are options? Options are financial contracts that give traders the right, but not the obligation, to buy or sell an underlying asset at a specified price within a certain time frame. There are two main types of options: call options and put options. A call option allows the holder to buy the asset, while a put option gives the holder the right to sell it. To understand the rights and obligations associated with options contracts, consider this. If you purchase a call option, you have the right to buy the asset at the strike price, but you're not required to do so. Conversely, if you sell a call option, you have the obligation to sell the asset if the buyer decides to exercise their option. Let's illustrate this with a simple example. Imagine you buy a call option for company XYZ with a strike price of $50. If the stock price rises to $60, you can exercise your option, buy the shares at $50, and potentially sell them for a profit. On the other hand, if the stock price falls, you can choose not to exercise the option, limiting your loss to the premium you paid. This flexibility is what makes options an attractive trading tool. Types of options. When it comes to options trading, understanding the different types of options is essential for developing effective strategies. The two primary categories are American and European options. American options can be exercised at any time before the expiration date, providing greater flexibility for traders. In contrast, European options can only be exercised on the expiration date itself, which can limit trading strategies but often comes with lower premiums. Beyond these standard options, there are also exotic options, which have unique features that set them apart. For example, Asian options are based on the average price of the underlying asset over a specific period, while barrier options become active or inactive when the underlying asset reaches a certain price level. These exotic options can be tailored to specific market conditions and risk profiles. Each type of option can be utilized in various trading strategies. American options are ideal for traders looking to capitalize on short-term price movements, while European options may suit those with a more long-term outlook. Exotic options can be used for hedging or to take advantage of specific market scenarios, offering traders a diverse toolkit for navigating the financial landscape. Understanding options. Pricing. Options pricing can seem complex, but breaking it down into key components makes it more manageable. The two main factors that influence an option's price are intrinsic value and time value. Intrinsic value is the difference between the underlying asset's current price and the option's strike price. For example, if you hold a call option with a strike price of $50 and the asset is currently priced at $60, the intrinsic value is $10. Time value, on the other hand, reflects the potential for the option to gain value before expiration. The longer the time until expiration, the higher the time value, as there's more opportunity for price movement. Volatility also plays a crucial role in options pricing. Higher volatility increases the likelihood of significant price swings, which can enhance the potential for profit. As a result, options on volatile assets typically have higher premiums. Market conditions can further affect option premiums. In bullish markets, call options may become more expensive due to increased demand, while put options might see lower premiums. Conversely, in bearish markets, put options may rise in price as traders seek protection. Understanding these factors can help you make informed trading decisions.
Basic options, strategies. For beginners venturing into options trading, starting with simple strategies can build confidence and understanding.
One fundamental strategy is buying calls, which involves purchasing a call option when you anticipate that the underlying asset's price will rise. The potential reward is theoretically unlimited, while the risk is limited to the premium paid for the option. For example, if you buy a call option for a stock at a strike price of $50 and the stock rises to $70, you can profit significantly. Another strategy is buying puts, which is useful when you expect the asset's price to decline. By purchasing a put option, you have the right to sell the asset at a predetermined price. The risk is again limited to the premium paid, while the reward can be substantial if the asset's price drops significantly. A covered call strategy involves owning the underlying asset and selling call options against it. This approach generates income through premiums while providing some downside protection. It's effective in a sideways market where you expect limited price movement. Each of these strategies offers unique risk and reward profiles, making them suitable for different market conditions. Risk management in options trading. Managing risk is crucial in options trading, as it can be a double-edged sword. While options offer the potential for significant profits, they also come with inherent risks that traders must navigate. One of the primary risks is the possibility of losing the entire premium paid for an option if it expires worthless. Additionally, the leverage involved in options trading can amplify losses, making it essential to approach this market with caution. To minimize losses, traders can employ several techniques, such as using stop-loss orders. A stop-loss order automatically sells an option when it reaches a predetermined price, helping to limit potential losses. This strategy allows traders to exit positions before losses escalate. Moreover, establishing a solid trading plan is vital for success in options trading. A well-defined plan outlines your goals, risk tolerance, and specific entry and exit strategies. Sticking to this plan helps prevent emotional decision-making, which can lead to costly mistakes. By prioritizing risk management and adhering to a structured approach, traders can navigate the complexities of options trading more effectively and protect their investments. Tools and resources for options. Traders. For beginners in options trading, having the right tools and resources can make a significant difference in your learning curve and overall success. One of the first steps is to choose a trading platform that offers a user-friendly interface. Platforms like Robinhood, Thinkorswim, and E-Trade are popular among novice traders for their intuitive designs and helpful features, making it easier to navigate the complexities of options trading. In addition to trading platforms, educational resources are invaluable. Consider reading books like Options Trading for Dummies or The Options Playbook to build a solid foundation. Online courses from platforms like Udemy or Coursera can also provide structured learning experiences. Engaging in online forums, such as those on Reddit or specialized trading communities, allows you to connect with other traders, share insights, and ask questions. Lastly, using simulators is a fantastic way to practice trading without risking real money. Many platforms offer demo accounts where you can experiment with different strategies and gain confidence before diving into live trading. By leveraging these tools and resources, you can enhance your understanding and skills in options trading effectively. How to place an options trade, step by step. Let's walk through how to place an options trade using an online brokerage. Step 1. Open your brokerage account. First, log into your brokerage account. Platforms like Robinhood, TD Ameritrade, and Webull offer options trading, but you may need to request approval to trade options. Step 2. Select a stock. Decide which stock you want to trade options on. Look for stocks with good liquidity and trading volume, as this makes it easier to buy and sell options. Step 3. Choose the option type. Decide whether you want to buy a call or a put based on whether you think the stock price will rise or fall. Step 4. Pick the expiration date. Choose an expiration date that gives your trade enough time to play out. Short-term options expire in days or weeks, while longer-term options, known as leaps, can last months or even years. Step 5. Select a strike price. Pick a strike price that matches your strategy. Options closer to the current stock price tend to be more expensive but have a higher probability of making money. Step 6. Place your order. Enter the number of contracts you want to buy and review the total cost. If you're comfortable with the trade, submit your order. Common questions about options trading. How much money do you need to trade options? Beginners can start with as little as $100, depending on the stock and strategy. However, having at least $500 to $1,000 allows for more flexibility in choosing contracts. How do you know which strike price to choose? If you expect a small price move, choose a strike price closer to the stock's current price. If you expect a big move, an out-of-the-money option might offer higher returns. Are options riskier than stocks? Options carry more risk because they expire. However, with proper risk management, they can be used strategically to reduce portfolio risk. We've explored the essential aspects of options trading, starting with the fundamental concepts and types of options, including American and European options. We discussed the intricacies of options pricing, highlighting the significance of intrinsic value, time value, and volatility. We also introduced basic strategies like buying calls and puts, as well as covered calls, emphasizing their risk and reward potential. Additionally, we touched on the importance of risk management and the tools and resources available to help beginners navigate this exciting market. Understanding options trading is crucial for anyone looking to enhance their investment strategies and capitalize on market opportunities. Thank you for watching, and don't forget to subscribe to our channel for more financial insights and analysis. Check out this next video.